Hello class, welcome to Unit 15, Price the Only Revenue Generator. The pricing framework. You set pricing objectives, estimate the demand, determine the cost, analyze factors affecting pricing decision, determine pricing strategies and pricing policies for making price adjustments, set initial prices, offer and make price adjustments as needed. Various pricing objectives. There's the targeted return on investment, the profit an organization hopes to make given the amount of assets or money it has tied up in a product. Maximizing profits, set prices to increase revenues as much as possible relative to costs. Maximizing sales, pricing products to generate as much revenue as possible, regardless of what it does to a firm's profits. Maximizing market share, which is set prices allows capturing a larger share of the sales. Maintaining the status quo, meet or equal of competitors' prices. What are the pricing factors? Your customers. How will buyers respond to those prices? Three important factors you need to consider. Will buyers perceive the product offers value? How many buyers are there? What is the size of your target market? How sensitive are customers to changes in price? Price elasticity. What is price elasticity? It refers to people's sensitivity to price changes, which affects the demand for a product. Equal to percentage change in quantity demanded divided by percentage change in price. Price elastic. Consumers are very sensitive to price changes and buy more at low prices and less at high prices. Price inelastic. Buyers are not sensitive to price changes and demand is relatively unchanged. Price elasticity equals percentage change in quantity demanded divided by the percentage change in price. Competitors. A firm's pricing decisions are affected by how competitors price and sell their products and the availability of substitute products. The economy and regulations. Weak economies and high unemployment call for lower prices. Currently, we are experiencing inflation and increase in interest rates, expensive products. So our economy is it's shaky right now. So it's soon to show like negative impacts. So right now, people are more interested in maybe making sure their money is in a safe place, making sure they're investing in safe investments rather than taking bigger risks. And maybe at this time, not a lot of people are opening up businesses just because either the mortgage for the place that they're trying to build their business at, maybe it's more expensive than they thought. There are other challenges. Maybe they want to, maybe businesses don't want to operate in this state due to increased taxes, so they're moving out of state. There are a lot of things to think about. In international markets, currency exchange rates affect pricing decisions. Pricing decisions are affected by federal and state regulations. Robinson-Patman Act limits price discrimination. Price fixing or firms agreeing to charge the same, usually high price, is illegal. Unfair trade laws protect smaller businesses by preventing larger businesses from selling products below cost. Predatory pricing, which is setting low prices to drive competitors out of business. Bait and switch pricing, in which a seller baits customers with low prices and then tries to switch them to higher priced products, is illegal in many states. So your first extra credit question is to list 3 other countries outside of the United States and what is the currency exchange rate to our dollar? Again, your first extra credit question is to list 3 other countries, your choice, and then the currency exchange rate to the US dollar. An example of price fixing. This is a conversation between the CEOs of American Airlines, Robert Crandall, and Braniff Airlines, Howard Putnam. So Crandall says, I think it's dumb to pound each other and neither of us making a blank dime. Putnam says, well, and then Crandall says, I have a suggestion for you. Raise your fares 20%. I'll raise mine the next morning. Putnam says, Robert, Crandall says, you'll make more money and I will too. Putnam says, we can't talk about pricing. Crandall says, oh, blank, Howard, we can talk about any blank thing we want to talk about. This is a conversation made between 2 CEOs or 2 leadership CEOs of the airline industry. This is illegal, and if caught, the company could incur fines and also negative publicity. Product costs. The costs of the product that are taken into account when a pricing decision is made include the amount spent on product development, testing, and packaging. So do costs related to promotion and distribution. The offering stage in the product's life cycle can affect its price as well. If a company has to open brick and mortar storefronts to distribute and sell the offering, this too will have to be built into the price the firm must charge for it. Like I said, that's why a lot of companies are thinking, do we want to pay those amount of taxes, or do we want to move to some place that has less tax and we can account for all these other expenses? The break-even point is where total costs equal total revenue. This is where it becomes zero. You've made the money and it equaled what you put into creating the product or service that you're providing. Total costs include both fixed and variable costs. Fixed costs are costs that must be paid regardless of production or sales level, salaries, utilities. Variable costs are costs that change with the company's level of production and sales. BEP, total fixed cost divided by contribution per unit, or total fixed cost divided by the difference between unit price and unit cost. Total fixed cost divided by unit price minus unit cost. So this is the break-even point formula. If you were to use it, it would be BEP equals total fixed cost divided by contribution per unit. Contribution per unit equals MSP minus variable cost. Introductory pricing strategies. Skimming price strategy, a high initial price for a product aimed at consumers who are willing to pay a high price and buy products early. Over time, the price of the product goes down as competitors enter the market and more consumers are willing to purchase the offering. Think of a product. This is another extra credit question. Think of a product that came out really expensive, but then it became to the price goes down slightly, not even like by a lot, but it's because consumers are willing to buy it, whether it's expensive or not. Penetration pricing is low initial price set to get as much of the market as possible. Often, many competitive products are already in the market. Say, for instance, a new soda wants to come out. You've got big companies like Coca-Cola, Pepsi. It's going to be hard to get into that industry or come out into that market. So those other off-brand sodas are selling lower so that they can also sell their product to the same people that are buying Coke and Pepsi products. Everyday low prices, the price that seller expects to charge throughout the product lifecycle. Walmart uses this theme in their advertising. Pricing approaches. There's the cost plus pricing. Market pricing uses the cost of the product and then adds a profit to determine a price. The most common pricing approach ensures a company's cost and profit are covered. Markup, money added to the cost of a product to set the final price. Markdown, the amount of taken off the price in a price reduction. Odd even pricing, pricing a product a few cents below the next dollar amount or a few dollars below the next $100 or $1,000 value. For example, odd even pricing is $9.99. That's not $10, so it must be a good deal. Or 99 cents. That's not a dollar. Prestige pricing, utilizing a higher price to give and offering a high quality image. Another extra credit question. Can you give me an example of a product that has odd even pricing and a product that has prestige pricing? Price lining is pricing a group of similar products at different price levels. Demand backward pricing starts with the price demanded by consumers and create offerings at that price. Price approaches continued. There's the leader pricing, pricing one or more items unusually low to get people into a store. Loss leaders, items priced below cost to bring people into stores. This is illegal in many states. Sealed bid pricing, process of offering to buy or sell products at prices designated in sealed bids. Online auctions such as eBay give customers the chance to bid and negotiate prices with sellers until an acceptable price is agreed upon. Forward auction, buyer lists an item to buy, sellers submit bids. Reverse auction states how much one is willing to pay for it. Going rate pricing occurs when buyers pay the same price regardless of where or from whom they buy the product. Price bundling, selling different products or services together, typically at a lower price than if each product or service is sold separately. So let's say you go get an oil change and they offer you a car wash at the same location, a free car wash. Some other price approaches include captive pricing, where pricing products when firms know customers must buy specific replacement parts because there are no alternatives. Product mix pricing, deciding how much to price a firm's products and services that go together. Two-part pricing, a strategy in which providers have two different charges for a product. Payment pricing, a strategy in which customers are allowed to break down product payments into smaller amounts they pay incrementally. Another extra credit question, can you name a payment pricing model that is out there right now in different retail stores? There's various retail stores that use this payment pricing method. Promotional pricing is a short-term tactic to get people to purchase a product or more of it. What is price discrimination? Charging different customers different prices for the same product. In some situations, mostly retail, price discrimination is legal. Price discrimination is used to get more people to use a product. A company might lower its prices in order to get more customers to buy an offering when business is slow. Price adjustments, changing the listed prices of products. Quantity discounts involves giving customers discounts for larger purchases. Pricing adjustments businesses. FOB free on board origin or FOB free on board destination. Continuing on the price adjustments, there's uniform delivered pricing where buyers pay the same shipping charges regardless of where they are located. Trade allowances, discounts given to channel partners. This happens at trade shows. Reciprocal agreements, agreements in which merchants agree to promote each other to customers. Maybe a Circle K promoting Bang energy drink. Bounce back, a promotion in which a seller gives customers discount cards or coupons. We get those like if you're part of a loyalty program at Ralph's or any other grocery store. Usually they send you discounts on the app or scanning coupons that you can use for a discount on eggs or the items that you buy on a regular basis. And that was a super fast presentation. pricing is really important, but it's also very short and straightforward. There's no like if, ands, or buts about it. There were a few extra credit questions, so I advise you to make sure you know what those extra credit questions are. If you have any questions, make sure to contact me. All right, have a good evening.